right? So
Okay.
that's how it will be measured all the time. So the initially it is fair value to profit or loss, only the fair value. In the other tree, fair
Yep.
value plus transaction cost. Now
Exactly. Yes.
when it comes for the subsequent measurement,
Yep.
that is at the end of every financial year or every reporting period, we have to measure it at the subsequent. Here again,
Okay.
we measure it. Say now today is, let's assume today we are on somewhere in December. Let's assume next year,
Yep.
March, we are going to prepare our financial statement. So today we
Okay.
will initially recognize either at 100 or 105, whatever it is.
Yeah.
Right? Let's assume on 31st March 2016, when we are preparing
Yeah.
financial statement, you will again remeasure at that day the fair value here.
Okay. So number one. So number one, the fair value to P&L
Yeah, the fair value
will
to
also be
P&L will be measured at
will
fair value on that day. So let's put some
so
figures. Let's put some figures. 100 is the original figure. Here it is 100 plus
okay.
505. Here also 105. Here also 105. That is the initial recognition.
First one is 100. The rest one is 100. Rest are three or 100. 100 plus 5.
100
Okay.
plus 5 because the first one 5,000
Plus transaction.
we charge
Yeah.
it to the P&L.
Yeah.
So that was the initial. That is as
The
at
rest are
yeah. That's as at
yeah.
today.
The
December.
rest are two plus transaction costs. Yeah.
Transaction cost added up. Now
Added up.
we come to the 31st March 2016 maybe.
Yeah.
So the fair value to profit or loss again we remeasure at fair value. So maybe the value
Yeah.
at that time is 110 for example,
Okay.
right? 110. So that is what the fair value is. The held to
Okay.
maturity and loans and receivables, it is not measured at fair value. It is measured
No.
at what we call amortized cost.
Okay.
Amortized cost. So I will explain what is amortized cost, but you will know
Yeah.
it is not measured at the fair value.
Okay.
It is measured at amortized cost. Then available for
Okay.
sale, again it will be measured at fair value.
Okay. Available for sale is fair value
Fair value.
again.
So
So remeasured at fair value. Yeah.
number one and number four
Yeah.
subsequently measured at fair value. So let's assume it is 110.
Okay.
Let's assume it is 100,
Yeah. Okay.
right? The number two
Okay.
and three, which is done with what we call amortized cost.
Both of them are amortized. Okay.
Amortized cost. So now you have a
Amortized.
gain here. In the first one, there's a gain. From
Yeah.
100 to
Okay.
110, there's a gain. This we will take it to the P&L.
Okay. So number one, 100 to 110. This equals the gain. So this is goes to P&L. Okay.
P&L. Keep the 2 and
Yep.
3 for a moment, but let's look at the 4. It has gone up from
Yep.
105 to 110. That 5, we will
Yes.
recognize into the other comprehensive
Other comprehensive
income. That
income.
is the bottom
Okay.
part of the P&L. After arriving
Yeah.
at the
Yep.
profit
Exactly.
after tax, we add up the other comprehensive income. It is recognized there.
Yeah.
Now I just want
That's
to,
just the other additional 5K. Yep.
that's correct. That's additional 5K will be recognized at that and the other comprehensive
Yep.
income. It is considered as unrealized income and it is kept there.
Oh, okay, right. Unrealized income.
Yeah.
Okay.
Now I want to just take 2
Yeah.
minutes and explain this amortized cost one. So let's look at the held to
Okay.
maturity. You recognize the initially at 105. So
Yeah.
initially held to maturity was recognized at 105. So let's
Yeah.
assume it was recognized at 105 and the examiner
Yeah.
will tell us the effective rate. Effective rate. So maybe that you have taken a investment where the coupon rate
Yeah.
of interest what they pay is let's assume it is 5%.
So coupon rate is 5%.
Coupon rate
Yeah.
is 5%. The coupon rate is always paid on the nominal value which is 100. Even though it is we appear it as 105, the nominal value was 100.
Yes.
because that 5 was the transaction cost. So they don't pay on
Yeah.
the transaction cost. The coupon rate will be always paid on the 100. So let's assume
Yeah.
the coupon rate is, let's assume for the moment it is 5%.
Okay.
5%. So they will pay. But the effective
Mm-hmm.
rate is totally different from the coupon rate, because what you did
Okay.
was you invested 105 and you are getting just 5%.
Yeah.
So that means your effective rate is less than 5%. Let's assume it is 4%. Examiner might tell you it is 4%.
So the effective rate, you invested 105, but
You,
on 105
you invest
you're only
105,
getting
but you get
4%.
interest only 5. So that means it is less than the normal 5%, because it's on 100 5%, but on
Yeah.
105 it is
Yeah.
less than 5%. So the examiner will tell you the effective rate is something.
Yeah.
So let's assume he says it is 4%, for example.
Okay.
So what we do is what is called the effective rate is what we look at. We look at the 105, and if it is
Yeah.
4%, we will charge 4% on this one. On the 105, 4% will be charged. So
Charge 4%. Okay.
105 into 4%. Let's assume for the moment, let's assume it is 4.2. So
Yeah.
you will charge. So what you will do is you will credit this account held to maturity account. Sorry, because this is
Yeah.
asset. No, I made a mistake. Since this is asset, it will appear on the other side, 105.
Yeah.
Right? And now you
Yeah.
will charge this HTM account with 4.2, crediting your
Yeah.
P&L with 4.2.
Okay. Yeah.
So instead of the normal thing gain going to the 10 P&L, here it will be 4.2 going to the P&L. That is the effective rate.
Okay. Which is
Effective
the
rate.
effective rate? Okay.
Effective rate.
Yeah.
And then you will get from that particular investment the coupon rate. Let's
Mm.
assume you get 5.
Okay. Yeah.
So when you get 5, you debit cash and credit the HTM with the 5.
Okay.
So now you can see the balance in figure. 105 plus 4.2, 109.2. The balance in figure is
Yeah.
104.2. And that is what we call the amortized cost. So at the
Yeah.
subsequent,
So
yeah,
yeah.
at the subsequent
No, sorry.
remeasurement, yes,
Yeah.
at the subsequent remeasurement, you will take that as the figure, not the fair value, charging interest, deducting the coupon rate of interest, you will show the amortized cost.
So you charge interest and deduct
Yeah, at the
coupon.
at the effective rate of interest, let's put it like that. At the
Yeah.
effective rate of
Yeah.
interest, deduct the coupon rate of interest,
Yeah.
and that will be the amortized cost.
Deduct
Coupon
coupon
rate of
rate
interest,
of interest. Yeah. Okay.
that will be the amortized.
Okay.
Mhm,
Okay. So now
mhm.
where held to maturity was 109.2.
Yeah,
It's now
109.2 minus 5.
104.2.
Now it will appear for the next year as 104.2.
Okay. So originally,
It was
going back to what
105.
we had 105, right?
Originally we had 105. So what we did was we add the effective rate 4.2, deducted the 5,
Yeah.
and we show it as 104.2.
So 105 plus the
2
4.2 minus
minus 5.
5.
Minus 5.
Okay, and this goes to again P&L.
This will appear in the balance sheet, just like here. This figure, the value of the asset will always appear in the statement of financial position. Here it will be 110. Here it will be 104.2. Here also it will be the similar story, 104.2. Here it will be 110. All will appear in the statement of financial position.
So this will go to balance sheet. Okay.
Balance
So
sheet.
with the first one, just to get it right, the first one was 100.
Mhm.
So then
Subsequently
obviously
we
our
get it
remeasurement was at fair value was 110 at 31st March.
Yeah,
So that gain goes to the P&L. So that
that goes to the
10K goes
P&L
to
gain,
the P&L.
and the
Yeah.
asset will show at 110 in the balance sheet.
The asset will. Yeah. Okay. So then asset
We
will.
show at 110 in the balance sheet.
in balance sheet. Okay. And then the second one, we started off at 105 because the 100 plus the 5K, so that was fair
Right.
value plus
Right.
transaction cost.
Right.
But then we added the effective rate.
At effective rate, that will go to the P&L.
Yeah, and then we deducted
We deduct the coupon rate. Coupon rate
we
what we
deducted the
got,
coupon rate.
and that
Yeah, so
figure
we
will
now
be,
have
that
so
figure
we
will
have
be amortized,
104.2,
and the
which
4
will go to the balance sheet.
it will go to the balance sheet, and that 4.2 will go to the balance sheet, to the income statement, to the P&L.
And 4.2 goes to P&L. Okay.
Same
Yeah,
story
so this
with,
is two sides. Okay.
same story with the loans and receivables also.
Yep.
Same way, same treatment, the loans and receivables.
Okay.
So available for sale, again it will be measured at fair value. The difference we charge it to other comprehensive income.
Okay, so where we started here, we started 105 again.
Yeah. Hmm?
100 for loans and receivables. We started at 105.
Yeah.
Here, do we
Yeah.
still have the effective rate and the same
Yeah,
thing?
still we'll have the effective rate, the same story like the HTL.
Okay,
Same.
minus the coupon rate of 5,
At the
which will be
at the
104.2.
effective rate, deduct the coupon rate.
Yeah, okay.
Same
And so
story.
the same thing, the 104 goes to the balance sheet and
Balance sheet,
4.2
and
goes
the
to P&L.
4.2 will go to the P&L. Yeah, right.
Okay, so right, okay, that's fine.
Hmm.
And then on the number 4,
Yeah.
the available for sale. So we
Mhm.
started at 105.
Yeah.
The remeasurement, the fair value was 110. So that extra 5K goes to the other comprehensive
Other
income,
comprehensive
and
income.
it is
Exactly.
unrealized income.
Exactly.
Okay.
You are right. That's correct. So that is as far as the 4 assets are concerned. Right. So
Okay.
now let's look at slightly on the 2 liabilities are concerned. So there can be 2 types of
Okay.
liabilities. One is what we call the fair value to profit or loss. Other one is the
Yeah.
financial liability. So initially it is 100 because the transaction cost
Yeah.
5 charged to the P&L.
Okay.
Here it will be
So initially,
initially 95 because the transaction cost is deducted.
the financial, yeah.
Liability. This is financial liability.
So the first one will be 100, and the second one will be 95
95 because the financial transaction cost is deducted from the liability.
deducted.
In the
Yeah.
earlier 3
Okay.
assets we added up, but here we deducted.
Yeah.
So this is the
Yeah.
initial measurement.
Exactly. Yeah.
Initial measurement.
Yeah.
Then we come to the subsequent measurement. Just like in the fair value to profit or loss asset, this will be measured
Yeah.
at that time against the fair value. So maybe it was 100 and now it
Okay.
is, let's assume it is 105.
Okay.
So your liability has increased by 5,000.
Yeah. Exactly.
So that's a loss. When the liability increases, it's a loss. That will be charged
Yeah.
to the P&L 5,000. This is subsequent. This
So
is at
liability increased by
5,000.
5K, which means that you're making a loss.
You are making a loss, and that will be charged to the P&L. That is as at 31st March 2016.
Yeah.
Yeah?
Okay.
That is as at 31st March 2016. So this will go to the P&L.
Okay. Yeah.
This will go to the P&L, and this 105 will be shown
Mm-hmm.
in the statement of financial position as a liability.
And 105 will be shown as
A liability under the,
statement of,
yeah,
yeah, statement of, sorry, so it'll be shown where, sorry?
31st March 2016. It will be shown as a
Yeah.
liability.
The 105K, yeah?
105K. That's correct.
Okay.
So every year you will do the same thing. Every year you will
Okay.
value it. Next year it may be coming down to 99. Then you have a gain.
Yeah.
And it will go on like that every year.
Yeah. Mm-hmm.
Then let's look at this one. This again, like in the assets, this goes on the amortized cost. Like the held to
Okay.
maturity, this will go. So we have a
Yeah.
liability of 95 to start off. Financial liability, we have a 95 to start off. To this, we add
Yeah.
the effective rate of interest. So we
Yeah.
will be paying because it's our liability. So we will be paying, let's assume on the nominal value, we are paying 5%. That is the coupon rate.
Okay, so
But
coupon rate again,
yeah,
5%.
coupon rate is 5%. Let's assume you are going to pay 5%. But what we
Yeah,
are going to charge to the P&L is the effective rate. So let's assume in this case, because we have bought 95 but paying 5, that means the effective rate will be, let's assume it is 6%, because it has to be more,
okay.
because we are paying on a
Yeah,
95.5, that means it's more than the normal thing.
yeah,
Let's
yeah,
assume it is 6% for just for calculation purposes. So we will be
yeah,
charging 5.7,
yeah.
right? We will be adding to the liability 5.7, which will go to the P&L.
Okay, this is the effective rate,
This
the
is the effective rate.
5.7.
Yeah, at the rate of 6%, on the 95, it
Yeah,
is 5.7. 6% of
yeah,
95, right?
yeah,
5.7. And we will be paying the people the coupon rate, which is 5.
yeah,
So now we can see the balance in figure. So it is 100.7. And here it is, to make it 100.7, it will be 95.7, the
yeah.
balance in figure. So your subsequent measurement, statement of financial position, will have a 95.7, and the P&L will be charged with 5.7.
So here, okay, so
Mhm.
P&L will be charged,
With
so charge
5.7.
P&L effective rate, so 5, P&L will be 5.7, yeah?
Yeah, same as the earlier one. At the effective rate, deduct the coupon rate.
Okay. So there so then the balance, so at the balance sheet you'd get, you would have to put in
Yeah,
the
the balance in figure.
100.7.
We started
Oh,
off with
sorry, the
we
95 point.
started off with 95 and added up the
Yeah,
effective rate of 5.7, deducted the coupon rate
yeah.
of 5, and you will show it as 95.7.
Okay, yeah. So that is goes to the balance sheet, the
That will go to the balance
95.7.
sheet.
So balance sheet. So okay, we started off. So here we started off with 95.
95
We added
added up
the
5.7, the
the
effective rate, which
5.7.
goes to the
We
P&L.
deducted 5.
Yeah,
Yeah. Okay, that's how you get to that.
yeah.
Yes, exactly.
So that's the treatment for the 6 subsequent measurement treatments.
Okay.
Right? So this is what actually, this is the trickiest part, that what we are trying to get at. So we will be looking at some questions. So subsequent measurement
Yeah.
of other depends on how that particular is classified, with 4 types of
Yeah.
financial assets, 2 types of financial liability. So financial liabilities we were discussing last time. Financial liabilities
Yeah.
are generally all liabilities other than fair value to profit or loss. So example, a
Yeah.
bank loan is a financial liability. So
Yeah.
basically short-term loans, what we basically trade is what we call fair value to profit or loss. So
Okay.
find a fair value to profit or loss. As you see, we record it at the fair value, that is
Yeah.
without the transaction cost. Transaction cost we
Yeah.
charge to the P&L. Restate at the fair value at each year. So it was originally 100. It was restated at 110, and the gain or loss was taken to the P&L.
Yes.
But here, if it is financial liability, recorded at fair value less cost, which is recorded at 95, subsequently
Yeah.
measured at amortized cost. In that case, we add the effective rate, deduct the thing, and we showed it as something like 104.7 or something like that.
Exactly. Yeah. Yeah.
So amortized cost is worked out in the following manner. Opening balance year, debit cash, credit liability with net proceeds. Then effective interest
Hmm.
is calculated, debit finance cost, credit liability, coupon rate paid, credit cash, debit liability. And the final balance is
Okay.
what we will show in the amortized cost.
Okay.
So that is what we learned last time. So now let's
Yeah.
proceed from there. Already I've explained a little bit. So we were talking about something called a compound interest instrument. That is
Yeah.
basically a convertible instrument. We remember the companies can issue a particular instrument today
Yeah.
as a loan with the option for the lender to convert it into shares at a given date maybe when he converts, he gets 120.
Okay.
So today it is 100. So you get 100 into your bank account, but
Yeah.
they have the option to convert. But during this period, maybe the next 4 years, during this period, you will pay the coupon rate of interest, maybe 5.
Okay.
So here we have to work out, there are two components in this one. So what we do is, okay, we pay 5 in the year 1, we pay 5 in
Yeah.
the year 2, we pay 5 in the year 3, we pay 5 in the year 4, and also we are committed at the end of the period, at the time of the thing, 120. So
Yeah.
all that what we are going to pay, we will try to bring it to the present value, and let's assume the present value of all these things once we discount it, and the
Yeah.
discounting rate is the rate of a unconvertible bond. A bond that is not convertible, that is the discounting rate we will use it here. So let's
An
assume,
unconverted bond, right?
yeah,
Yeah. Okay.
yeah. When we convert, when we bring all those present values, let's assume the present value of all this is 90, for example. I'm just putting up example
Okay.
just to show. So we got
Okay.
100 today. So we have to debit
Yeah.
cash with 100,
Yeah.
and the present value of all what we are going to pay as a loan, the liabilities present value is 90. So we credit
Yeah.
liability with 90.
Yeah.
The balance 10 is considered as equity. This is what we call a compound instrument.
So the balance, which is
The
10,
balance in
equals
figure.
equity.
The balance in
Yeah.
figure is considered as equity.
Okay.
So this is the initial measurement. Now we have already initially measured it. It's at 90 and 10.
Yeah.
And now, as I said, the equity is never subsequently measured. So it will be
Yeah.
always 10.
Yeah.
At the end of year 1, year 2, year 3, year 4, it will be always 10. But the loan component will be subsequently measured at the amortized cost.
So the equity will never be remeasured. So will
There will be never
always
be
remain
the
at
measured. But as we said
always
as
remain
we
at 10.
learned earlier, the loan
Yeah.
part of it will be subsequently will be amortized, will be measured at the amortized cost.
But loan component.
Just like what we did earlier on the 90,
Yeah.
they will add the effective rate, whatever, right? And they will deduct the coupon rate and will appear maybe at 95 next year.
So okay. So equity is never remeasured and will stay at 10, but the loan component will
That's
be
correct.
remeasured at the
That's correct.
amortized
Yeah.
cost,
Yeah.
which is the original value, what do you call
Open
it, nominal
original value
value.
plus the effective rate minus the coupon
Nominal
rate
value. Yeah. Plus effective rate
minus the
minus
coupon rate.
coupon. Yeah.
So that will go on till you come to the final fourth year or the fifth year.
Okay.
So that is what we call a compound instrument, which is a hybrid instrument where you have the characteristics of both equity and of loan. So they are
Okay.
compound instruments.
Hybrid instrument meaning it's able to be
It
converted.
has the characteristics of equity and loan.
Okay. Yeah.
It has the characteristics of equity and loan. So IAS 32 requires the compound financial instruments to be split into two parts: financial liability. That is measured
Yeah.
the present value of future cash flow. So all what you are going to pay, including the redemption, using a discount rate that equates the
Hmm.
interest of similar instrument without conversion.
Okay.
So we don't use our coupon rate because our coupon rate is including the conversion, right?
Hmm.
Without that one, we will work it out and do that one.
Okay.
So that is that is the figure that I arrived at 90, for example, in the earlier case.
Hmm.
And the balancing figure is the equity.
Yes,
So
exactly. Yeah.
100 we received, 90 we considered it as liabilities, 10 will be
Yep.
considered as the balancing figure as equity.
Okay.
So it will be shown,
Yeah.
even though we have received 100, it will be shown for 90 as a liability, 10 as a
Mm-hmm. Yeah.
in the statement of financial position initial recognition.
Okay.
Subsequently, the 10 will remain 10. The 90 will change with the amortized cost.
Yeah.
That is what we have been doing, right? So,
So this will.
so subsequently, the liability component is measured on amortized basis, and the equity component will remain unchanged.
Okay, and the 10, the equity, that goes to the statement of financial position?
Both will go to the statement of financial position, the loan part and the equity part. But the equity part will be shown on the top as on the equity part. The 90
Yeah.
will be shown under non-current liabilities under the liability.
Okay. Okay.
Both will be shown. 90 will change figure every year. 10 will remain 10 forever.
Okay.
So that is basically. So transaction cost. Now here also they maybe have a transaction cost. Maybe you have to
Yeah.
pay a transaction cost of 5, for example. That
Mm-hmm.
5 will be worked out according to the proportion. In this case, 9:1.
Yeah.
The ratio 9:1 because the equity component, loan component is 9, equity component is 10. So 9:1 will be worked out. So actually 4.5 will be deducted
Yeah.
from the
Yeah.
equity loan component. 0.5 will be deducted from the equity component.
Okay.
Initially, it will be done, and that's it.
Yeah.
So it is done on prorated basis between the equity and the liability component, the transaction.
Okay.
So these are the little
Okay.
tricky things we need to learn. Okay. So now we
Yeah.
come to the financial assets. So as I said, there are 4 financial assets. One is fair
Yeah.
value to profit or loss. Mainly, all what is held for short-term trading is considered a fair value to profit or loss. So
Yeah.
essentially, these will have to be in listed companies because that
Okay.
means because you are going to go on short term. So that means you have a market value all the time. And that is why you
Yeah.
can measure it as subsequently every year at a particular price. And that's what we call the subsequent measurement. So that essentially it will have to be all on the listed company.
Okay.
So
And
that's
shares held for short term?
share sell for short term, investment sell for short term. It can be even a bond held for short term.
Okay.
Right? It can be even a bond held for short term. Those are essentially the short term kind of assets, and that is what basically the characteristics of that one. So,
Okay. Yeah.
right? So that's the number one. Then the second one we have what we call held to maturity. So this is the
Yeah.
intention is the most important word is the intention is at the very beginning the intention is to hold it till maturity. That is
Okay.
that is you take you invest on a bond which is going to mature in 2020 and your intention is to hold it till 2020.
So you hold the bond until 2020.
2020. At least the intention. Sometimes you may not be able to hold it, but the intention is to hold it till 2020. Right? So that kind of a thing we call it held to maturity.
Why wouldn't you be able to hold it? What would be the reason?
Yeah, maybe suddenly you have a
So what would be the reason to not hold it? And
yeah, but suddenly because you have good intentions today you put a fixed deposit for example which is going to mature in 5 years time
yeah.
2020 but maybe
Yeah.
suddenly something have cropped up and you have to withdraw it.
Okay.
Suddenly some financial crisis has come up and you have to withdraw it. So intention was to hold it. True enough, suddenly you have to do something, but the intention is
Yeah.
what matters. So long as the intention is there, you will classify it as held to maturity.
Okay.
The first one, you never have the intention of holding for a longer period. You are just holding for a short period, and that is why it is called fair value to profit.
Okay.
So it's not, it has to be a very genuine intention. Say if your company is in big financial crisis and if you go and buy some bonds which is going to mature in 2020, you know for certain
Yeah.
you can't hold it In that case, you can't classify it as held to maturity.
Yeah.
You
Okay.
might say my intention, but the evidence will prove that you cannot hold it, and therefore it cannot be
Hmm.
classified. So it's not only your intention, it has to be evidenced by the fact that you have the
Yeah.
capacity to hold on till 2020. So
Okay.
basically, the investment in debentures, which is going to mature in 5 years' time, redeemable preference shares, which is going to mature in 10 years' time. They are the things what we call held to maturity.
Okay.
Right? So that's basically the ability, you have the intention to hold it. Then we have the loans and
Yeah.
receivables, but they are surely not listed. So simply the trade receivables, if you give me a loan, because they are not quoted in the stock exchange.
Yeah.
So there you don't have a market value, and that is why you go on the amortized cost loans and receivables.
Okay.
Right? So they are,
Okay. So you have to use amortized cost for this one. Yeah.
yeah, because
Exactly.
the second and the third, you will go on the amortized cost.
Yeah.
Even the first, second, third, the second and third, we will go with the amortized cost, because even
Yeah.
though they may have a market value, we don't take the market value. We go by the intention and then we take the amortized cost. Third one, you will never have a market value because they are not quoted. So you can't sell it in the stock market. They are trade receivables
Yeah.
or loans. So that kind of a thing, you will have to do it on the amortized cost. So that's the third category.
Okay.
Then we have
Okay.
the fourth category, which is basically anything that is not covered in other three categories. So
Okay.
it's not a loan, it's not a fair value to profit or loss, it's not a held to maturity, anything that is not covered up dumped in the fourth category. So good example of a
Okay.
fourth category is the shares in a quoted company, but not held for short term, but held for long term. Yeah,
Okay, so this is okay, so shares hold for long term instead of
long
short
term.
term. So in the first one where it was fair value and it was only for short term or
Short
bonds
term.
held for short term,
Second,
this would be bonds held
the
for long
fourth
term.
one is because the shares don't have a maturity period, but if you are
Yeah,
holding for a long term period, the it,
yeah.
then it will come under available for sale.
Okay, so shares held for long term would come
Long
under
term.
this
Yeah.
category.
So generally, this will be again quoted shares because you will have a market value.
And this category, and they would be quoted. Okay,
Right? They'll be quoted, but they are held
quoted
for long term purposes.
because they have a market value.
They
Okay,
have a
yeah,
market value. So the second and third, you don't have a market value. First and fourth have a market value. So that is why first and fourth, you remember I told you subsequent measurement will be at the
yeah,
market value. Second and third
yeah,
will go on the amortized cost.
yeah.
So these are the four types of assets. So one question will be always, where will it you categorize it? Initial category. It is very important. Will it be fair value to profit
Okay,
or loss? Where it will be available for sale? So the examiner's information given will make you to judge whether it should be under category 1, 2, 3, or 4.
okay, yeah,
Right. So the measurement of financial assets as the fair value to profit or loss, as I said, it is recorded at the fair value. Expenses are considered transaction costs, charged to P&L. At the end of every year will be restated at fair value. Any gain or
yeah.
loss taken to P&L.
Okay, yeah,
Held to maturity, amortized cost, transaction cost always added to the asset value.
yeah,
And of course, the gain or loss, I mean, there is no gain or loss, the effective interest will be charged to the P&L.
yeah,
Loans and receivables, same treatment as held to maturity. No change.
yeah, yeah,
Available for sale, record at fair value, transaction cost added up 100 plus 505, restated
yeah.
at the fair value at each reporting date. Any gains or losses taken to reserves, that is to the other comprehensive income. Till it
So
is
record at fair value, add transaction cost, yeah. And
100 plus
restate at
5,
fair value at
105,
each.
and
Yeah,
100
restate
plus
at fair value.
and restate at fair value 110. The difference 5
Yeah.
gain or loss is taken to reserves to other comprehensive income.
Okay, yeah, yeah.
The 5 is always taken to the comprehensive income because that is considered unrealized income.
Yes.
The day
Why is
that,
it unrealized?
because you know you're holding it for a longer period. So
Okay.
things can change and therefore it is
Yeah.
not recognized as a profit or realized profit.
So not yet recognized as profit. When will it be recognized as a
That's
profit, or
correct.
when can it be?
The moment you dispose the asset,
Okay.
at that time when the asset is sold, gains or losses recycled through P&L. All what
So
was
until you.
taken to the other reserves will be now
Yeah.
taken to your P&L because now it is considered realized gain or realized loss.
So this will be a profit then. Oh yeah, realized gain or realized
Yeah,
gain, which
that's
becomes.
correct. At that point, when the asset is completely wiped off on the balance sheet, at that stage, you will consider it as a gain.
So for example,
Mhm.
so realized loss. Okay. So you say, okay, so it's unrealized income until we sell the asset, until we
Until,
dispose of this
exactly.
asset, right?
Yeah.
So so after we sell this asset, or dispose of this asset, we
Mhm.
then get a value. So say the asset is worth 100,000 at the beginning,
Okay.
right at the original value,
Okay.
and then we sell the asset, but okay, we only get 80,000
Yeah.
for the asset,
Mm-hmm. Mm-hmm.
when we sell it. So that would be our realized loss.
That's
Yeah,
correct.
because we lost
Yeah.
20k
Yeah.
at the end of the disposal.
Yeah.
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 Okay.
That's correct. Because now, for example, the first example we said 105 was the initial recognition.
Yeah.
And by the next time it came to 110. So this 5, the gain is reflected in the reserves as 5,000.
Yeah.
So to the other comprehensive income, it is taken. Now you sell the asset. Let's assume you can sell it at 110, for example, right?
Yeah.
Because the book figure is 110 at this point,
Yeah.
and you sell it for 110. So when you get the money, you credit cash with 100 and debit cash with 110, credit this account with 110,
Yeah.
asset gone. And at that time,
So
yeah,
debit cash 110 and credit
debit
the
cash
asset.
100 and debit cash 110, credit the asset with 110.
Yeah.
So asset completely disappeared from
Okay.
the balance sheet. At that time,
Yeah.
the corresponding reserve, which was 5,000, also should be
Yeah.
recycled to the P&L. Now, this is
Oh,
appearing
okay.
here because it is unrealized. So you will debit reserves with 5,000, credit your P&L with 5,000 at that stage.
Okay, so you credit P&L 5k.
1,000 and debit your reserves with 5,000 because you have to close the reserve account because now no longer you have a reserve account because you have subsequently sold the asset.
Okay, so you have to basically write. So are you writing down the reserve account, or are you
Yeah.
moving it somewhere else
No,
to
you,
the P&L?
you pass a journal entry, debit reserves
Yeah.
and credit the P&L.
Okay. What is the aim of this because we've
That
sold
is
the
because
assets.
that
We
is
don't have
because
the asset.
we have sold the asset. So why we were keeping that in a reserve was because the asset was not yet sold and it was unrealized
Yeah.
profit. Now the moment it
Yeah.
is sold, no longer asset, and therefore it's not no longer unrealized, it is realized.
Yeah.
So you take it to the P&L.
Okay.
The first one, the fair value to profit or loss, whether it is realized or not, it is considered realized because they are short term.
Yeah.
That is the reason.
Okay. Yeah.
So that's the subsequent measurement. So as you asked me, the when will it be recognized? When the asset is sold.
Okay. Yeah.
Moment asset is sold, the reserve will be recycled to the P&L. It will be
Okay.
taken from the reserves and charged and credited it to the P&L.
Okay. Taken to P&L. Yeah. Okay.
But
And so you do this journal entry to take it to this P&L. You
that's correct. Yeah.
take it so you debit that reserve for account
Yeah, because you have to
K and
close the
credit
reserve
the
account now.
P&L.
You have to close the reserve account
Yeah.
because it's no
Yeah.
longer a reserve account now, right? Yeah.
Can that not be put into, why can't that be put into retained earnings? Because that was your reserve that you did get
That is
5K from that.
basically the P&L means retained earnings.
Okay.
P&L means at the end of the end, the P&L balance goes to the retained earnings.
Okay.
So you don't just transfer it to the retained earnings, you transfer it to the P&L to the retained earnings.
Okay.
Understand? Right? Because you can't just go
Yep.
and straight away put it to, because then there will be a kind of an unexplained movement. So every transaction is
Yeah.
done to the other comprehensive income, we have credited the reserve. Now through the
Okay.
P&L, through the P&L, we will take it to the retained earnings.
Okay.
The difference is when it is in retained earnings, it is
Yeah.
distributable as dividend.
Okay. All right.
When,
Okay. Yes, that's
when it
true.
is under reserves, it is not distributable as dividend.
No.
That is the reason. That is why we keep it under reserve, because we don't want them to distribute it as dividends, which is not yet realized.
Yeah. But you cannot distribute as dividend
Dividends
under
when it is
reserve.
unrealized, and therefore it is kept as reserve.
Distribute if it is unrealized. Okay.
That is the reason. So that is why the accounting people have gone into that extent, because otherwise people can just take credit and distribute it as dividend and the company can collect.
Yeah. Yeah.
Because later on they will realize that it's a loss, and by that time the whole thing is gone. So you don't want to.
Yeah.
Now we are coming to another very important area, impairment of financial assets. So the impairment will apply only for the two categories, held to maturity and loans and receivables. Reason, the other two, that is the fair value to profit or loss and available for sale, always we measure it at the fair value. So impairment will be straight away considered.
So only applies to categories 2 and 3.
Only the categories 2 and 3, because 2 and 3 we don't go by the subsequent fair value, we go by the amortized cost. So you remember we were looking at a particular asset, 100 was the beginning. No, the beginning
Yeah.
was 105. We added something like 4.7, deducted 5, and then we arrive at something like 99.7 or something like that.
Exactly.
That
Yeah.
is the
Yeah.
amortized cost. But you might find at the
So
end of the year, 31st March, even though the book figure is 99.7, the real market
yeah.
value of this asset is 94,
Yeah.
or say line 90. Now that is what we call an impairment,
Yeah.
right? Impairment. Because the
Impairment is when you have isn't impairment when you have goodwill and then um
goodwill
the
also,
value of that goodwill is reduced.
goodwill is also an impairment. Now assume a loan. You are given me a loan, right? You are given me a
Yeah.
loan and you gave me a loan of 100, and you
Hmm.
have to incur a 5,000 transaction cost. You showed it as 105, and at the end of the
Yeah.
first year you took credit 4.7,
Yeah.
and I paid you 5 and you show it at 99.7. Now you find
Okay.
between January and March I have gone bankrupt,
Yeah.
and you are not going to recover 99.7. The liquidator
No.
of my company says you will only get 90.
Okay.
So that is what we call impairment. Goodwill also gets impaired. This is not a goodwill impairment. This is an impairment of one of your assets. The asset
Okay. Yeah.
value has dropped in value.
Okay.
It could be due to many reasons. Maybe I'm going bankrupt. Maybe the country situation is such that you can't recover, right? Whatever it may
Okay.
be, it is dropping. So this is what we
Yeah.
call impairment. So the moment the
Yeah.
impairment comes, first thing what you must do is you have to immediately, the accountancy prudency concept says we must drop it to 90 straight away. Even though we went on 99.7, that's no
Yeah.
longer valid. You have to drop it by 9.7 million, debit the P&L with 9.7, credit the asset with 9.7, and bring down the asset straight to 9.
Okay, and 90 means the value
The
before,
impaired value.
after.
The impaired value.
Okay,
The latest
yeah.
value what we have as per market statistics.
So you must bring the asset down to the impaired value.
Impaired value.
Okay, yeah.
Only
Because
thing
that's what it's worth now, right?
that is what very much. Only thing on the prudency concept, we don't increase the value. You might find that it is yes, you might find that it is going up to 106, but you will not increase it to 106, but you will reduce it to 9.
Okay, yeah.
Yes, right. Today they are here. So
Are they, yeah,
yeah,
your
yeah,
grandchildren?
yeah. Right. So you have to immediately impair. And that will only
Okay,
happen to the two items, the HTM and the LNR, because the
yeah,
first one, number 1 and 4, no problem, because they are always at the fair value.
yeah,
So immediately the gain or loss is reflected.
yeah.
So that's basically something what is called the impairment. So the moment there's
Okay,
an impairment, we have to find out at each reporting date, see whether there is any impairment. You are giving me a loan,
okay,
you must see
yeah,
whether I'm living, whether I'm in a position to repay. If not, bring that impairment. And
okay.
if there's evidence of an impairment, a detailed review should be undertaken. And the impairment loss is the difference between
Yeah.
the carrying amount 99.7 and the present value 90. So that one will be immediately charged to the P&L.
So difference between carrying amount and the present
And the
value.
present
Okay.
value of the cash flows, that is what you're estimating to receive from me, will be the impaired value.
So carrying value minus present value. So carrying value is cost minus depreciation.
That is in the asset, but this is the carrying value with cost plus effective rate minus the impairment. Cost plus effective rate minus the coupon rate, that is the amortized cost is the carrying value.
Minus coupon. Okay, that is the carrying value. Okay, minus the present value.
Yeah, amortized cost is the carrying value minus the present value, that is what we call the impairment.
Okay, okay, so CV and PV is the impairment value.
Yeah,
Yeah,
yeah.
the value that it's worth
PV
now.
minus PV, yeah, right.
So, okay, so if the original value is, what did we say? If the original value, if the carrying value is, I don't know, 100.
Yeah, the originally we had 105, right? And
Yeah,
then we added 5.7, we deducted 5 or something like that. We had a
yeah,
99.7, the amortized cost.
yeah,
But that is the
yeah,
31st month amortized cost. But when you do a review, you see
yeah,
I'm not in a position to pay 99.7. And all what you are
yeah.
going to receive, because you may not get the all the money today, but you may get over a period of 3 years. The present value of all what you are going to get is 90.
So PV equals 90. Yeah, okay.
All the present value of all the money what you are going to get is 90.
Yeah,
So
okay.
99.7 is the carrying value. 90 is the present value of all what you are going to get. Maybe
Yeah,
2017 you will get some money, 2018 some money, 2019 some money. The present value of all that is 90. But your present
yeah,
liability, present asset is appearing at 99.7. That
yeah.
9.7 must be charged to the P&L immediately.
9.7 charged to P&L. Okay.
So that is what we do it. Basically, that is what, because IS 39 says immediately the impairment losses are recognized to P&L.
Okay, and this is this. So that 9.7, yes, 9.7 is the impairment loss. Yes.
Impairment loss charged to the P&L straight away.
Okay.
So that is what is going to happen. So then we come to another area, derecognizing of a financial asset. So the moment the asset is your contractual obligations or your contractual rights are over, you must
Yeah.
derecognize the asset. That is, you have invested on a held to maturity till 2020. The 2020 comes up. At that point, after that, you have no right to receive any more money. You must at that time remove the asset from your balance sheet.
So in 2020, no right to receive any more money.
Now, because your contract is over.
Yeah.
So the moment that happens, that you have
Yeah.
to remove it. Or maybe the ownership of the financial asset, whatever, it is now the substantially all the risk and rewards of the asset are no longer with you. It is transferred to
Yeah.
some other party. Maybe you have a bond, right? You have invested in some
Yeah.
government treasury bonds. You are transferring it to me. So all the risk and
Okay.
rewards you are transferring it to me. Now in that case, it must get out of your balance sheet.
Yeah.
It must come up in my balance sheet. So it all depends on who is carrying the risk and rewards. That person only should carry the asset in that balance sheet.
Yeah.
So
Depending
upon
on who's carrying risk
derecognition,
reward. Yeah.
so upon derecognition, again we have to look at the what we are going to get. So maybe ultimately this loans and receivable at the amortized cost, you might have a figure of something like 105.2.
Yeah.
As at say today, as at 31st December, you have a figure of 105.2. And
Okay.
the contractual obligations are over as far as I'm concerned. I pay you 100.
Okay.
So that 5.2, you
Hmm.
are not going to get it. Now no more
No.
contracts, all gone. That
Yeah.
5.2 should be charged to the PM.
Okay.
So that is also like an impairment. Impairment, we do it every year. This is at the
Yeah.
closing stage, final. The final balance
Yeah.
figure. Whatever the difference that we are not going to get, put it to the PN.
Yes. Okay. So the 5.2 is the difference we did not get yet.
What is shown in your books and what you got it. If you get more than that, you are showing 105.2, you are getting 110. That difference also take it to the PNL as income.
So is the 100 what I so if I had the asset at 105.2,
No, but
is the 100 what
is what you
is
have,
the
is
amount that I've
what
transferred it to you?
is the amount that I will pay you. You are showing it as
Okay.
105.2, but I will pay you only
Yeah.
100. And I say, thank you very much. Contract over.
Okay.
Contract over. And both the parties agree the contract is over. In that case,
Okay.
you are not going to get the 5.2, so transfer it to the PNL. Finish it off.
Okay.
That's all you do. So sometimes it may so happen 105.2 is what is appearing. You might get 110.
Yeah.
That 4.8 is a PNL credit.
Yeah.
You remember that I told you impairment, we don't recognize the increases.
No.
We recognize only the downfalls. But at the closing, because it's not a question
Yeah.
of recognition, it's a question of actual real fact. I showed it in books 105.2, but you are paying me 110, and that is a
Mm.
realized profit. So I can consider that 4.8.
Okay. So in impairment, we don't recognize the increase, only losses, right?
Yeah,
Which is true. That's what
in
impairment
the
is. Yeah.
review impairment, we don't recognize the increases or gain. But at the
Okay.
closing final stage, gain is a gain.
Okay. So then what happens to this 4.8 then?
That will go to the P&L straight away as an income, additional income. So you
Okay.
showed it as 105.2, you got 110. So debit this asset with 4.8, credit the P&L with 4.8.
Okay. Yeah.
Debit asset with 4.8, because otherwise you can balance this account, because you have to clear this account, credit the P&L with 4.8. So now the asset account is cleared 110. Just
Okay.
like you recognize
Yeah.
the loss, recognize the gain at the final closing stage.
Okay.
So that you can do it. You are permitted to take the gain at that point, but not when you are during the impairment, not during the review stage.
Okay.
So that is something that we have to. So if the asset was classified as AFS, any gains or losses accumulated within other components are reclassified. So you remember that we told when it is available for sale, all our gains or losses are in those reserve account. And now
Mm-hmm.
when we clear up, that reserve account should get cleared up to the P&L.
Yeah.
So I said that 5,000 we will charge it to the reserves and credit to the P&L. So it may be 5,000, maybe 50,000, whatever that is
Mm-hmm.
in that reserve account. At the closing stage, at the derecognition stage, you have to change it, turn it to the P&L.
Okay. Yeah.
So that's something which we will be learning. Yeah. So now we have to look at another new area, but I won't start that one today. The factoring of
Yeah.
receivables and the derivatives, we will do it in our next session because I want you to
Yeah.
master the couple of things that we learned today. The next lesson,
Yeah.
I will finish up and I will look at some questions also because the questions
Yeah.
will make it much more clearer for you the all what we have learned.
Yeah, this session is much clearer actually. Last session I was just completely
Yeah,
lost because it
yeah,
was so
yeah.
complicated.
Yeah, that
But
should
this
have,
time is better.
yeah, should have been better. Yes, I'll send you both
Yeah.
these uploads for you.
Okay, perfect.
Right. So we can meet on. We will meet on next Tuesday.
Do you want to? Okay, because next Friday is now
Next Friday we will not be able to
Christmas.
meet. No.
No, yeah,
Yeah.
let's not meet next
Yeah.
Friday.
Next Friday we will
So
not
we can
meet. But
do, right.
mhm,
We'll meet on Tuesday for P2 on the
yeah,
22nd,
that's right.
and then we can do maybe F2 on possibly Thursday. Actually, not Thursday. Actually, maybe.
Mm-hmm.
Oh God. Okay. Let's decide on Tuesday what works
Okay.
actually, because
Okay.
I'm
Just
not
let
sure
me know.
about this.
Yeah, because we will avoid the Christmas day and then we will try to work it out another day for you.
And Saturday, Boxing Day, no,
Yeah, that's right. Yes. Yes.
possibly. Yeah,
Yes.
not these two.
Right. Yeah.
Okay, let's try to work it out then.
Okay.
So
Yeah.
let's
Yeah.
definitely meet on
Let me know
Tuesday
on
anyway.
Tuesday. But your program is
Yeah,
we'll try to work out something.
perfect. Okay, that makes
Or
sense. Thank you so much
maybe
for
like if you are free, we may be able to do double session even on Tuesday, like what we did last time.
possibly.
Yeah, just
Yeah,
let me know.
possibly. Yeah.
Whatever your base, whatever your time thing, we'll try to fix it up.
Okay, perfect. That sounds good.
Okay, take care.
Thank you. Take care.
Bye,
Bye.
bye, bye.